Come closer, a little bit closer. You know, borrowing money from the bank is a non-taxable event. Oh!
Borrowing money from the bank is a non-taxable event.
So I got this from Ben Mueller from Graham Stephan's interview with him, and he mentioned that borrowing money from the bank is a non-taxable event. You can borrow money at the bank without being taxed, and you can invest how you want. So in this video, we'll discuss 3 options to borrow money against your own property or rental property you have. We'll look at cash out refinancing, and we'll look at personal loans and home equity line of credit. So stay tuned, watch the video to the end, and we'll choose which options is best for you. So number 1, we'll talk about cash out refinance. So what that is day and age, you have seen the interest rate rise to 6% and home value has gone up. So if I bought a house for $200,000, now assessed in 2023, it's assessed at $400,000. So the difference is $200,000. So I have an equity of $200,000. Now I can lower my interest rate or cash out the house, which means if it's a 30-year mortgage and I go refinance the house, I can get the difference of $200,000, or I can just borrow against my equity. So I can take the $200,000 out and can use it to buy whatever I want. And it's non-taxable. Crazy, right? The government sees money borrowed against your property or any kind of real estate that you have as money borrowed rather than not an income. So that's why it's non-taxable. All right. So it could be almost to say it's the 9th wonder of the world. And according to Credit Karma, that equity that you have, the $200,000, is not taxable because it's a loan against the property. So basically, you take out a loan against the property. You didn't actually earn the money. It was assessed and through equity that you were able to take out $200,000 against your house. I know there's some opponents out there that may be leery and say, hey, you're taking out $200,000 against your own property. So the other thing is you're resetting the clock on your mortgage amount now. So there's a little stipulation there, pros and cons there. Again, I haven't said already, I'm not a financial advisor. What I bring here to the table is some examples that you can use to pull out equity and use that money to do other things like invest in other properties. Next is a HELOC, or home equity line of credit. The second one we have here is by Investopedia, which is home equity line of credit. What it is you're borrowing against your house like a credit. So basically, you want to have a $100,000 credit card. You would use this to secure it with your house. Just like a credit card, what happens is you take out, let's say you want to borrow $100,000, you use the $100,000, $90,000, renovate your house. Once you pay that down, it gets restart back up again, so that you will always have $100,000 if you pay down the balance. Key takeaways we have here is the line of credit is based on your home equity to use to buy, build, or substantially improve. So according to Investopedia, you can use it for debt consolidation or paying off credit card debt, but it will no longer be tax deductible. That's the only difference. So you can use it. It's not just saying that you can't. We can use it, but the difference is you won't be able to deduct those tax savings. But if you're paying 25-30% on credit card, then it's well worth getting the HELOC loan. So according to the IRS, interest on a home equity line is only deductible when the proceeds are used to buy, build, or substantially improve your home that secures the loan. However, if you use this to pay back credit cards, living expenses thereof, you will have to pay taxes on that. The next is personal loans. So personal loans, this is more like a home equity loan, basically. It's not like a HELOC. It's a set amount, because a HELOC is like a credit card. So the revolving money versus a personal equity line of credit. It's one set amount of money that you borrow from the bank based on your property or rental property you have. A home equity loan is a set amount that you take out. Let's say you want to borrow against your house. It's a loan you borrow against the house. Let's say you want to borrow $50,000. That's it. It's $50,000. That's what you get. It doesn't reset if you pay down the principal or the balance. So let's take a look at the best lenders out there according to NerdWallet. A whole bunch out there: San Diego County Credit, Carrington, Flagstore, there's a whole bunch of Navy Federal. I'll leave the link in the description below. That way you guys can check this stuff out yourself and make sure if this is right for you. You know, I love giving out bonuses because you're stuck around so long. Probably most of you will still have questions about, well, how about what's a 1031 exchange? So we'll go through that. So 1031 exchange is, so you have a piece of property, you sell that property, you make $100,000. Let's say you sell a piece of property you bought for $100,000 and you sell it for $300,000, you make a profit of $200,000. So that $200,000 needs to be taxed as a capital gains. But in a 1031 exchange, you can use that money, the $200,000 that you were able to obtain, and buy another piece of property that's in higher in value. Let's talk about 1031 exchange. So let me preface this with that this is like high level stuff as far as being a real estate investor, which I aim to be one day. What you can do is you can buy another piece of property with the proceeds, the cash that you receive from selling this old property, and buy another property that's higher in value. So that's why I call it 1031 exchange. It's just a tax code the IRS uses. This is way more in depth that I would like to go into. Obviously, you need to get a tax professional, real estate attorney to figure out if this will work for you. And like I said, this is high level stuff, and we're just gonna just graze the surface of what 1031 exchange is, so that we're kind of, if we heard it, we've seen it before, that hey, Sid from Hunter and Chavy Investments that had talked about this. So key takeaways from 1031 exchange: it is a tax break. Like I said, you sell the property, you hold business investment and swap it for a new one that's used this for the same purpose, but usually higher in value. Don't take my word for it. Check with a tax attorney and figure out if that's right for you. And then you can use it to buy a like-kin property that in the eyes of IRS, its capital gains will be deferred. So any kind of properties akin to that, then you can defer it. Again, there's certain rules you have to abide by. So in 45 days, the money has to be in an escrow account to purchase another property, as we see here from Investopedia. But you have to close within 180 days after the exchange of the closing to get the qualified 1031. The two time periods run concurrently, which means that you start counting as soon as the sale of your property closes. For example, you designate a replacement property. The 45 days and the 180 days run concurrently. So just be aware that as soon as that property closes, 45-day clock begins, and then you have addition to the 45 plus 35 and 180 days to close on the new property. If you like these type of videos where we talk about personal finance, today about borrowing money against your house and cost savings, either by doing stuff yourself to save any kind of money that you can, then click the subscribe button, leave a comment below, and did you stuck around for the bonus round, put 1031. Listen, you're here watching these videos because you believe that financial freedom can be obtained, and I appreciate every single one of you watching these videos. I'll see you in the next one.